then what you will do is you will visit this screener.in/excel. So this is the website, this is the URL you visit. So it will take you here. It will ask you to upload the customized Excel file. Choose file, upload our Excel sheet. That's it. So I know most of you might be already using our Excel sheet. I'm just, that would be the basic thing to cover. So that's why I started with that. So now, before this Excel sheet, before you actually go and export to Excel, here itself you can see few things. For example, you can check the PE ratio of the stock. So here you can see the current PE ratio is 57. Generally, if the PE ratio is more than 20, we don't invest in that stock for a simple reason. Because anyway, after valuing the stock, it will be overvalued. So generally, we don't invest in overvalued stocks. So our cutoff maximum is 20. So the maximum PE ratio that we invest is up to 20. Let's say if the stock is trading at 23 PE, we will not even export that Excel because, like I said, it will be a time waste for us. Anyway, we are not going to invest. But here it is 57. So I ignored that. Let me look at some other stock. So HCL Technologies, you can see 23 PE. So again, I will not export it. Along with the P ratio, you can go and check the P&L account here itself, like P&L statement, which is also called as income statement. So why income statement? Here I want to check the operating margins of the company. So with HCL, you can see there isn't a lot of fluctuation here. Mostly it is around 22, 23, except for 1-2 years. So here also you can see the margins. So they have changed. There is some difference in accounting. So previously there was a change in the business model. So previously it was a high margin business, low volume business. So from 2017 there is a change in the business model. So what happened is from low margin, now it is a high margin business, low volume business. So if you look at the net margins of the net profits of the company, net profits are pretty consistent. There is the only change is how the margins were interpreted. Previously the margins were very high, but the company didn't lose any of its net profits, as you can see, because you can see there is a huge jump in the revenues of the company. Previously it was high margin, now it is high volume. I think the last time I said it wrong. So now let's start the analysis. So the first, you can check the summary part. So here in the summary, basically you will find something like the share price or face value, number of shares outstanding, what is the market cap of the company. So very basic details you will find here. But generally I don't check summary, I'll directly jump into 2-minute test. And here pretty much the analysis starts here. So the first thing that I want to check is whether the company passed my 2-minute test or not. And in the last week, I covered 2%. Here the net profit drop is around 7%. So 4% drop, 7% drop is quite natural. With every business it happens. So I still consider it as consistent growth company. The growth is pretty consistent. And the next thing I want to see is whether the company is receiving the cash or not. Whether the cash is coming into the business or going out of the business. I want cash to come into the business. So the cash generating capacity is what we look for. Without cash flows, net profits doesn't make any sense, because end of the day, if the company is posting high profits but not receiving any cash, then that is pretty much paper profits. Eventually, if the company is not able to collect the cash, then obviously those paper profits are worth on equity. So in the profitability analysis, you will understand when they changed that business model, that helped the company in generating high return on equity. So for the first 4 years, return on equity was only 12 or 13%, but there was a change in the business model. Here you can see, previously it was high margin business. Asset turnover ratio was very low. So for that reason, you can see the return on equity was low. But eventually the business model shifted from high margin to low margin, but low asset turnover to high asset turnover. If you clearly observe, the margins dropped, but asset turnover improved. Because of that, the return on equity also improved. So they might have changed the business model, but it is for good. The return on equity improved. So over growth, we have to look at the growth in two ways. One is with HCL tech kind of companies where there is no change in the operating margins. With some companies, operating margins are so consistent, there won't be any drops in the net profit. But not every company is consistent. So with some companies, there will be slight cyclicality. So last week also I mentioned, when there is that fluctuation in the margins, don't place too much emphasis here. For example, 10-year it is, sorry, a 10-year growth you can see it is 16%, 7-year growth 20%, 5-year growth is also 17%. So these three numbers are indicating that it's a high growth company. But here you can see the last 3 years, it's a negative number. Why? Like I said, the margins dropped. But we are pretty confident that the margins will improve going forward. So that is the cyclical nature of the business. So when I look at the growth, I want minimum 15% growth, right? So when the net margins improve from around 9% to, I would say, from 9% to almost 13-14% net margin improvement. So the net profits of the company from 1500 crores can improve towards 2500 crores, which is very high. Very higher than 15%. Generally 15% is what we look for, but here once there is an improvement in the margin, the growth rate will not be 15%. It will be like mostly the net profits can double as well within no time. So that is what we are expecting. So we are not just looking at the past growth of the company. We are looking, whenever we are investing for future. So what plays an important role is, so how much the company can grow in next 1 year, in next 2 years, in next 3 years. But consistently, CAGR, more than 15% CAGR, then please don't avoid that company just because the last 2 years growth rate is low. What we are looking is future growth. Of course, we are looking at the past growth as well. But if there is a possibility for cyclical companies, for consistent companies, we look at the past growth rate. But for cyclical companies, so it depends on what data you are picking. So for example, if you are picking, let's say 740 as base and 1700 as the end number, growth will be very high. But if ratio less than 1, interest coverage ratio more than 6 or 7 is good. Here it is 49. So financial health is also pretty strong. Then comes free cash flow to sales. So free cash flow to sales, generally we look for minimum 5%. Now what this number indicates? Free cash flow to sales. It indicates the cash generating capacity of the company. So whenever we are investing in a stock, we look for high profitability, that is high quality profitability, high quantity profitability. How do you know the quality? Return on equity. Return on equity will help you understand the quality of profitability, whereas this free cash flows to sales will help you understand the quantity of profitability. If it is more than 5, then it is a high quantity profitability as well. So with GSPL, it is almost 13.39. So it clearly passed our test. So profits, it is making profits, cash is coming into the business, return on equity is good, growth expectation from here, there is a very high probability that from here on for next 2-3 years, the company can generate very high growth. Financial health is strong, free cash flow to sales, that is quantity of profitability is also really good. And coming to the PE ratio, current PE ratio is just 10. So it passed the test. Now why I have integrated all these things in one sheet is because generally the way we analyze a stock is, first you look at the balance sheet of the company. So whenever we are looking at the balance sheet, the current number plays more important role than the past numbers. So the current balance sheet, how the balance sheet stands today, plays an important role. With GSPL, you can see focus on the borrowings. The first thing that we check whenever we are doing the balance sheet analysis, the first thing we check is the borrowings of the company. And you can, in 2018, the company has almost 5,300 crores of debt on the balance sheet. Slowly, you can see the company was consistently cutting the borrowings, and current borrowings are only 149 crores. Significant drop in the borrowings. So, company consistently repaid, like paid the principal amount back, which is a good news. So, there are so many numbers, but generally we don't analyze like this. You can look at these numbers, but generally we place a lot of emphasis on the financial health analysis. So balance sheet CFA, you can check all these things as a percentage also. From 25%, it dropped to just 1%, which is significant improvement. But generally we check financial health analysis. So as you can see, financial leverage is very good, like less than 4, 0.02, almost debt free. Interest coverage ratio is also good. All three cells are in green. So its financial health is strong. If all the cells are in red, then we consider it as a bad company. I mean, company with weak financial health. Days in inventory. You can see the days in inventory. You can check the receivable days here. Lower is always better. With GSPL, consistently these numbers are improving. From 24, days in inventory is nothing but how many days the company will take to sell the inventory. So initially it was 24 days. So for 24 days, the inventory would lie on the shelf. But you can see the current numbers are only 5 days. So there is significant improvement in the inventory turnover as well. Coming to receivable days, from 86 days. So initially the customer would pay in 86 days. But now you can see that reduced to 23 days. So receivable days improved, inventory turnover improved. So as you can see, this is what we call as the efficiency. So efficiency numbers are significantly improving. So with financial health analysis, you can do this. Check is sales. I want sales growth. So for example, in 2015, let's say the sales of the company are 1,000 crores. In 2023, let's say the sales is 1,300 crores. I'm not interested in that stock because 1,000 to 1,300 in 7-8 years, I mean, that is a very low growth, right? So, but if you look at GSPL from 1,000 crores, the current number is almost 16,000 crores. So the sales of the company improved by almost 16 times, which is not a joke. 16x. So, and consistently improving. 100 crores, it increased to almost 1,600 crores, almost 4x. But 4x even after the drop in the net margins. So the net margins dropped. That is the reason it is only 4x. Or else it would be much higher than that. And here you can check the operating margins. So you can check the current margins with the long-term average. Here you can check the current margins with the long-term average. So as long as this number, the current margins, is closer to long-term average, it's fine. The current number lower than the long-term average is also fine because there is chance for improvement, which is a good news. But never invest in a stock when the net margins or operating margins are higher, significantly higher than the 10-year average. Why? What is the logic? Because what you should do as an investor is never invest when the cycle is at the peak. If you can do that, then on a portfolio level, you will not incur permanent loss of capital. Individual stocks also, you will never lose money if you apply that. Of course, we cannot say never. There might be hundreds of reasons why we might lose money in a stock. But if you apply this, I mean, it's one more added filter to you in terms of safety. So Got the point? Never invest when the current margins are significantly higher than the 10-year average. And also, look at the tax rate of the company. So generally here you can see 25, 26. Here it is just 6%. So, I mean, there might be some tax benefits, but you will find some stocks where the tax rate is consistently lower, like 10% or 12% or 15%. The effective or the marginal tax rate in India is around 30%, 25 to 30%. 18,000 or 19,000 crores. If you look at the net profits for the last 10 years, this company generated 10,277 crores as net profits. But if you look at cash flows, it is 18,000 crores. So cash generated is much higher than the net profits, which is a good news. And here you can see, so basically these are the three questions I ask whenever I am analyzing the cash flow statement. First thing is, what are the major sources of cash? That you will find here. Blue. What is blue? Cash flow from operations. I want operating cash flows to be the major source. Some companies generate cash by borrowing money, but that is a low quality cash flows, right? I want companies to run business, sell products or services, make profits, generate cash. That should be the major source of cash, not borrowing money or selling equity and raising capital. That shouldn't be the major source. With GSPL, you can clearly see the major source is cash flow from operations. Next question is whether the cash flow from operations are sufficient to cover the capex. So here you can see this is the capex. So capex is nothing but this is the amount the company is reinvesting into the business to buy land, building, plant, machinery, whatever, for future growth. And when you subtract this number, capex, from cash flow from operations, the free cash flows of the company. So, and of course, we use free cash flows while valuation as well. So here you can see the free cash flows are pretty positive, which indicates cash flow from operations are sufficient to meet the capex requirement. In some companies, it is not the case. Some companies, cash flows are not enough to cover the capex. Then what the company can do at that point in time? Maybe they have to sell additional equity. They might have to borrow money. But that is not the case with GSPL. Very comfortably, this company can meet its capex requirement consistently, more than 15%. Here also, for the first few years, it was less than 15, but once there was a change in the business model, you can see consistently more than 15%. Overall, the long-term average is also around 21. So far, what's the conclusion that we have made so far? Cash flows are positive. Free cash flows is very good. Coming to financial health is also strong. Borrowings reduced for the last few years. Currently, the borrowing number is very low, almost debt-free. So, growth expectation, that is going forward, the margins are going to improve. So, growth will be very high. This is what we call as business analysis. So, we are done with the business analysis, and so far, GSPL is a high quality stock. Till that point, the analysis, DCF valuation, intrinsic valuation we call. So there are two ways to value a stock: relative valuation, intrinsic valuation. For relative valuation, you can use this particular sheet, relative valuation sheet. But let me be very honest with you. If the P ratio is less than 20, listen to me carefully. If the P ratio is less than 20 and in the income statement, the current net margins, current operating margins is lower than or more or less closer to long-term operating margins or long-term net margins, I am fine I don't even care about this particular sheet. I don't even check this worksheet. Margins should be in sanity. Margin shouldn't be at the peak. And P is less than 20. So I will ignore this. I will ignore this particular thing. And in the DCF valuation, obviously this is what I look for. Value per share. So value per share is 700. Share price is 291. Initial cash flows by default, the last 3 years is taken. So I am not adjusting. Generally with some companies I might adjust. But with GSPL, 1806 crores. Is it reasonable or not? It is pretty reasonable. You can see 1800, more than 1800, more than 1800, more than 1800. So in almost more than 3 years, this company already generated 1800 crores as free cash flow. So initial cash flow I am not going to adjust. With some companies I might adjust, but with GSPL no adjustment is required. So initial cash flow is 1800. I am not changing that number. Coming to the growth of the company, so return on equity I am taking the current number, that is 17.4. I could have made one small adjustment, that is instead of taking 17.4, because the current margins are lower. Going forward the margins will improve. So I can take this 20.9 as return on equity over there. So instead of 17, I can put 20 as well. But I'm not going to do that because I like to keep numbers conservative. If it can generate 20%, obviously the value per share will increase. But I like to be conservative, so I'm keeping it at 17%. I'm not changing that. So value per share 700, current share price around 300. But of course, we cannot rely on a single valuation metric. Or it might be initial cash flow. We are making some judgments. So we might be right, we might be wrong. If we are right, nothing to worry. But of course, sometimes we can make human errors in making assumptions. Then relying on just one simple framework would be risky. So for that reason, what I am going to do is, I am going to take the same DCF, I would divide into two parts, worst case and best case. So here with worst case, I am going to keep the growth rates very low, and with best case the growth rates will be higher. Worst case value is 620, best case value is 1000, and with DCF it is somewhere around 750, 720 and all, somewhere in between. But I am not going to focus too much on the higher end. I am going to check what would be the worst case valuation, around 600. So current share price around 290. So if you look at the current share price, so even with worst case valuation also, it is extremely cheap. Then comes the total returns valuation. So this is where we look at the investment return, speculative return. Total return is almost 19.79. I mean, this should be minimum 15%. Here it is 19 or almost 20%, which is good. So PEG ratio is something we look for. PEG ratio, as long as it is less than 1.5, great. Here it is less than 1, which is extremely good. So less than 1.5 is good. So here it is only 0.97, so extremely cheap. Various valuation metrics that we use: best case, worst case, DCF, total returns valuation, PEG valuation. We got 5 different valuations here. Which value should I use while making the buy decision? So what I generally do is, instead of relying on one valuation, I generally take the 5-year, the weighted average of all these values. I am going to assign a 20% weightage. Why 20% weightage? Because we have 5 values, 20% each, that would be 100% eventually, after adding up all the 5 valuations. So 20% here, 20% here. So after doing that, we got 635 rupees as the weighted average intrinsic value. Now I will consider this as the intrinsic value of the company. I have taken the best case numbers, I have taken the worst case numbers, I have taken everything. So after considering all these things, 635 is the weighted average intrinsic value. Then comes the entry prices. Entry prices are nothing but we add a margin of safety here. So for example, if it is if the intrinsic value is 635, it doesn't mean that we exactly pay 635. We might have made mistakes. So what we want is some discount. So margin of safety is what we call, and we enter a stock in three phases. First at 10% discount, then 20% discount, then 25% discount. So these are the values. What about the selling price? For selling price, what we do is we take the higher value. Of course, you can take this value, and also you can take the weighted average intrinsic value, 25% margin, exit 1, or 30% exit 2, 50% exit 3. You can do that as well. But if you are over aggressive, you can take the highest value here. So 1000 is the highest. So I am going to take 1000 as my base number when selling, add a 25% margin, 35% margin, 50% margin, and calculate the exit prices. Of course, we are not doing anything manually, everything the Excel sheet will compute. I'm just letting you know like how the process, from end to end, this is how the process begins and this is how the process ends. So it starts with 2-minute test. In fact, we have gone through so many worksheets, right? Cash flow worksheet or profitability worksheet or income statement and all. Of course, you can do this. We'll do more than 90% of our job. Market cap is here. Whether the company is making money or not, whether it is consistent or not, whether the cash flows are positive or not, free cash flows are positive or not, free cash flow to sales, return on equity, growth of the company, financial health of the company. So basically, when I started using this Excel sheet, 2-minute test, or in my previous sheet it was 10-minute test, they should pass our 2-minute test. If any company fails the test, I will not go and value the stock. This is the basic principle. If a stock fails the test, we will not value that stock. We will not waste our time. So 2-minute test is something that we place a lot of emphasis on. Of course, last week itself we have covered 2-minute test, but in this session is because most things you have already understood. Like I am getting so many questions from you, and I am really happy that you understood what the sensible investing process is. But what I feel is, even today, most of you are not checking the operating margins of the company or the net margins of the company. You are checking the remaining things. You are looking at financial health, you are looking at return on equity, you are looking at cash flows, but most of you are missing this point. So we get so many questions saying, what do you think of this stock, that stock? But those stocks might be trading at 3p, they might be trading at 5p, but the current margins are at the peak. So you can check that here. So this is also very important. Again, cash flow statement you can do. So that is what it is.